Good morning, welcome to the Killik podcast. So we've had more central bank action this week. We had the Bank of Japan cutting their rates last night. We had the FOMC meeting early in the week, which have become increasingly dovish. So you've seen bond yields in all of the major economies start to fall a little bit more aggressively since the start of the year, and that continues to be positive for value stocks in those particular economies, particularly in Europe. We've had extreme volatility in the oil price this week, so 10% fall early in the week, 22% rebound later in the week, and we've seen the forward curve in the oil price fall quite dramatically over the last year. So we've gone from $70 down to the $50 in the forward rate curve there. Mixed reactions this week from results, but Facebook was the particular standout that we want to talk about. 100 million hours of video watched daily through this platform now, 1.5 billion monthly active users, 200 million new subscribers every month. What's really astounding is they've managed to grow an ad revenue business that grew 80% year on year, but in 36 months, this business now does annualized revenues of $12 billion. And that's a huge number, clearly. There's still big upside for this. If you take the global advertising market of $600 billion and you apply the percentage time spent on a Facebook platform of 8% of all media, then you're getting a $48 billion revenue target for them. So they're still underpenetrated in terms of the advertising spend, according to those numbers. We'd be positive on Alphabet going into next week on these trends because those two businesses are really capturing most of this activity. Further to that, continue to be positive on growth stocks in a low growth environment with interest rates very low. Here, just got an interesting chart, median stock performance against overall market performance. That's just looking at the 50th stock in a 100 stock list as the median and comparing the performance of that over the year to the overall market. What it shows is that when particular sectors start to do particularly well against the overall market, and back in the 1990s you saw obviously a very extended period just because of the technology boom. Last year we started to see a little bit of that coming through, and our view is that with rates very low, with corporate returns falling but very rapidly in certain sectors and growing in certain others, we think this dispersion continues, and that's why we've got quite material exposure to those high growth stocks within portfolios. Looking at next week, we've got a very busy week ahead. BT, McCarthy and Stone, Alphabet Monday, BP, Ocado, Michael Kors, Church & Dwight Tuesday, Wednesday, Glaxo, Merck, Yum Brands, Syngenta, Thursday, AstraZeneca, Smith & Nephew, Royal Dutch, Vodafone, Cummings, and Friday, BG Group. So that's all from me. Thanks for listening. Have a good weekend.